Hey everyone, what is going on? It is Wilson. I'm back with another video, and in this video, I'll be going over some must-know day trading terminology or lingo, however you want to call it. These are pretty much terms that you see every day on Twitter. If you follow these people who are really good at day trading or traders in general, you see these terms again and again and again. And when I was starting off as a trader, I would follow these people on Twitter, or I'll see on forums, and I'll be like, what does this mean? What does this term mean? What is he trying to say? And all these times I was confused. And when I ask people, some people they just never respond, or they just don't want to tell you, right? So in this video, I want to kind of go over all these terms that you see every single day and what they mean exactly. So let's get this started. Again, you can follow me on Twitter at any time at Wilson the Trader. Or if you have any questions or some terms that I didn't mention in this video and you want to know what it means, just send me a tweet or DM me and I'll be more than happy to tell you what it means. So the first one, what does bullish or bearish mean, right? So bullish refers to when a stock market of the price is going up. So when the stock is going up, usually that means it's bullish. So people will say that I'm bullish on Apple, for example. That means that you're predicting that the price will be going up. So you hear on TV a lot like this is a bull market, means that the whole market is on the upward trend. And then bearish obviously means the complete opposite. It means is in a weak market, and usually when a trader goes like, hey, I'm bearish on Apple, it means that I'm predicting that Apple will be going downwards. These are some another bunch of common terms: HOD, EOD, SS, green, red, right? So HOD, high of the day, means that the stock has already reached the high of the day. Now, this does not mean that it has reached like a 52-week high, but it just means that for that specific trading day, that is it has reached its high. So, end of day means that the market is ending. So usually at 1 o'clock on the West Coast, it means that stock market is closing, so it's the end of the day. SS, we see this a lot. It means short sell. So usually, if you see a trader tweet SS Apple, means that they're initiating a position to short sell a stock on Apple, betting that it will go downwards. Green, obviously, it means you're in the green zone. You're doing good. The stock is above the opening price and is in the green. Or red, the complete opposite, means it's on the bottom. Now, another bunch of common terms: low float, SSR, ADR. These are a little bit more advanced, I would say, for day traders. Low float usually are those with a no number of shares. So usually these refer to like small caps. So for active traders who are day trading small caps, it's very important to know the float. I have a bunch of videos on float and how to trade low float stocks, so you can go look at those. But in general, it means that um, that that the stock will usually have a lot of volume, so a lot of price action. You will see rapid movements, rapid price jumps, like more in increments. It's not like you're trading Apple or Microsoft or Disney or one of these big large cap stocks where the stock barely moves the entire day with low flow. It means anything can happen. When there's a lot of demand, that thing will jump and pop. When there's a lot of supply, then it will fall short, or it will do a big pop and then bam, it will drop like a whole dollar. So that's what we want to get advantage of, or that's what we want to take advantage of when we're day trading, right? When you're a day trader and you're not a swing trader, you're not an investor, you're trading the stock, you want these momentum. Volume trumps everything. When there is action, that's when you want to get in, because you want those big gains, right? But at the same time, of course, there's also this risky side where there's a lot of big loss. Now, SSR, another more of an advanced term, but this is more of I would say a way that is an indicator that day traders like to use. Like, for example, if you're like a short seller, you most of the time you don't want to get into position with stocks that have SSR on. So it's pretty much, it restricts the stock from being able to short. So if you're short on a stock and let's say this SSR triggers, you don't want to get in it, because that means that there's just not enough people aren't able to short it anymore unless it's on an uptake. And this triggers when the price has declined by more than 10% from the previous day's close. And once it's triggered, the SSR will stay there for the rest of the trading day. So this makes it a lot harder, and most of the time you would not just there's just not enough momentum, because stock trading is about supply and demand, right? So when there's not enough supply, the stock will most likely go up because there's more people buying, because they can't even short it. So that's one thing you have to be aware of. ADR means average daily range. So over a certain period of time, for example, ADR 30 days means that that's the average day range within the 30 days. And usually the higher the number, the more volume and the more price action you will see. So the next one I want to go over is due diligence, ER, pre, and AH. Due diligence means you're pretty much doing your homework, you're doing the research on the stock, on whether your thesis about the stock is correct. So this could be anything from saying that, hey, I think going back to the example of Apple, I think Apple will go up, but what's the reason for it to go up, right? Do your due diligence. This can be looking into the fundamentals, or as well as looking at like maybe there's a news update, a new Apple event, they're launching a new product or something like that. Pretty much doing your own DD, which represents due diligence. Earnings report is ER. So when a company releases its earnings, this is a term that you typically see. A lot of traders would tweet like ER 120 price target. That means that the ER when the earning report is released, we're looking at a price target of $120. So pre usually means pre-market, and AH means after hour trade. So after the market closes, there's still that duration of like 3 hours where you can still buy and sell a stock. Usually volume is a lot less during that time, but there can still be a lot of price action. And this definitely goes with stocks that have low float and it has been trending for the day. Next one, chat pump, halt, and crowded. So chat pump, we see this phrase used a lot during trading sections. It means that, hey, this stock is jumping mainly due from a promoted from a chat room. So what does this necessarily mean? It means that usually the stock has so low float that if there's enough buyers buying this stock, it can create a pop, it can create a quick spike. And this has nothing to do with like the company doing well or anything like that at all, or no specific news. It's just one guy that runs a really big chat room that's telling people to buy it, and then everyone's following the crowd. Halts, this happens a lot, especially with stocks with a lot of price action. Is usually triggered when the stock kind of has extreme high volume and extreme high movement in the price action in a short period of time. During these time, what happens is that the stock will stop and it will disable trading. Pretty much nobody can buy, nobody can sell, and the stock prices just doesn't ever move for that period of time. It's usually pretty quick, and right when it resumes, it can have a massive drop or a massive gain. But during this phase, when the stock halts, it does not go anywhere. Crowded is another very well used term that you see a lot. It means that there are just a lot of actions, a lot of people buying, a lot of people selling, and these are the stocks that make it easy for a quick squeeze, right? So, for example, if you see a quick drop from because there's so much action, so much volume going on, it can cause a squeeze. And what happens is that if it's on the downtrend out of nowhere, you will see a big spike upwards with a huge price action. Next one, fail follow through and heavy. Fail follow through is usually when a stock tries to break out of, like, let's say a resistance point, is trying to push higher, 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 but it just can't do it, and bam, it drops. So it gets rejected, is what we will say. And this can usually what this means is that it means it's going towards a reversal, and it's going to be going downwards if it was going upwards before. This may also be a good time to kind of exit your position and say that, hey, okay, it's not going in my favor. Let's call it a quit and take my wins, take my profits, secure what I've already have. And then the heavy stock is when it struggles to pretty much gain upward momentum. So it's trying to push, it's trying to push, it's trying to break a VWAP, or it's trying to break the resistance and hit that new high of the day, but it just can't do it. So that means the stock is being heavy right now. Fade, wash, pop, reclaim. Fade, wash, I use this term a lot myself. It just means that, hey, the stock is dropping, right? So let's say there's a lot of momentum. It went from $55 to $60 in the first 2 hours of the trading, and bam, it starts to drop all the way back down to 50 or below 55 where it started, and that means that the stock has faded or washed out. Pop, complete opposite, means out of nowhere. Let's say the stock was consolidating, it's trading on a flat, and then out of nowhere it just pops up as a spike, and that's what a pop represents. Reclaim, usually it means like, hey, let's say the stock failed to hold a certain position, and it drops, and it's trying to reclaim back what it was before, or even go even higher. So usually it's more like the stock tanked and is trying to reclaim itself. Scaling in, this is a more advanced strategy for day traders. Usually what they do is that they scale into position to balance the risk and reward, right? So let's say that you're convinced that the stock will go up, and you want to invest a total of, let's say, 2,000 shares, right? You want to buy 2,000 shares, and what you do is that you start to scale in slowly as the trend goes with your momentum. So you would buy in increments of like 500 shares each until you reach your maximum amount of shares that you want to be able to purchase. You can do this in increments of 500. You can do it with half increments, like 1,000 each. It all depends on your risk management and what your strategy is moving forward with the momentum of the stock. Swipe, unwind, squeeze. I use this term a lot too. Swipe usually kind of just means a quick spike, right? Think of it as a lot of momentum coming up, and bam, it's just a pop. In other words, unwind means that a stock is downtrending with pretty much no resistance at all. So it's just all going downhill and it's unwinding. Squeeze is usually when the stock goes down and is unwinding, and then out of nowhere, everyone's covering the position. So all these short sellers are coming in position, and result that's a buy. So it's pushing the stock upwards. Anyways, those are the main terms. Thanks for watching. Subscribe and thumbs up if you like it. You can always follow me on Twitter at Wilson the Trader. If you have any other terms that you see a lot, or you just don't know what it means, feel free to DM me or tweet to me, and I'll be more than happy to explain this to you. Again, thanks for watching, and hope to see you guys in the next one.